Welcome back, my friends. Are office buildings going the way of shopping malls in the United States? The office real estate crash will be so sharp and deep that Capital Economics thinks office values are unlikely to recover by 2040. The research firm's top property economist likens the decline in office demand to what malls have experienced over the last 6 years, and sees a similar outcome. Institutional investors are pulling back from office real estate. What does it mean for real estate investment trusts? What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And, before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the healthcare professional knows the patient identity. In its original forecast on the impact of the pandemic on the office sector, Capital Economics said that office occupancy would fall by 7% to 8% by 2025, with that, vacancy would rise markedly and remain elevated through 2030. And those lower occupancy levels and declining rents would result in a 20% decline in portfolio incomes by 2025, all the while net operating incomes would remain below pre-pandemic levels through the decade. Now, the research firm suggests that the 35% plunge in office values we're forecasting by end 2025 is unlikely to be recovered even by 2040, in a new report published on Thursday. That means that offices are unlikely to regain their peak values in the foreseeable future, or in the next 17 years, for Capital Economics. That's because of dramatically lower demand following the shift to remote work that emerged from the pandemic. The report, written by Capital Economics Deputy Chief Property Economist, Kiran Raichura, likens the reduction in office demand to the experience of malls over the last 6 years as consumers have leaned into online shopping. There's been no real recovery in the mall sector that's been plagued by structural headwinds, Raichura said, and Capital Economics expects the office sector won't prove to be much different. We expect office landlords to face a similar fate over the next few years, with the prospect of a rapid bounce back in the sector's relative performance looking slim despite its sharp falls to date, Raichura wrote. As Fortunes previously reported, all commercial real estate is vulnerable to the Federal Reserve's aggressive rate hikes because it's largely built on debt. So with higher interest rates, the cost of borrowing goes up, and that can sometimes result in delinquencies and defaults. But on top of that, the office sector is suffering from a lack of demand because people are working from home. That's why the sector is considered to be the most at risk. Raichura said they have the data to support this view, comparing offices to malls. Raichura first pointed to a global survey by Knight Frank Cressa that recently found 56% of firms have adopted a hybrid work model, which he said is consistent with low rates of physical office utilization, like office keycard swipes that are close to 50% of early 2020 levels, which were only around 70% to 75%. Because of that, companies are moving to save on physical space. Office vacancy rose from 16.8% in the last quarter of 2019 to 19% in the first quarter of this year, Raichura said, citing the Real Estate Information Standards data. However, that might not be totally representative of the situation at hand. The true increase is roughly double that when sublease vacancy is taken into account, Raichura wrote in the report. And there's likely further to go. As a result, office vacancy has already seen a bigger increase than the 3.5% PTS increase seen by malls between H2 2016 and Q1 2023. Yet office net operating incomes were actually higher in the first quarter of this year than in the first quarter of 2020, according to the report. Still, office investors are moving forward with caution. Raichura wrote that major landlords have returned stranded office assets to lenders, and that will likely continue over the next couple of years considering the uptick in commercial mortgage-backed securities delinquencies seen in May. REIT investors are also shying away from offices, Rightsure wrote. A little more than 3 years into the downturn, the office REIT Total Returns Index is down by more than 50% relative to the all-equity REIT index. That is roughly on a par with the drop in the regional mall REIT Total Returns Index in the first few years of the retail sector's correction. The office sector hasn't hit its bottom yet, which is why Capital Economics suggests office values are unlikely to return to their pre-pandemic peaks even 17 years from now. Demolitions and conversions of the worst assets may partially counteract the impact on valuation-based indices, but ultimately landlords will have to bear those costs, so the road ahead for office owners is set to be an arduous one, Rightsure wrote. There is no doubt that commercial real estate is in trouble. Starwood Capital CEO Barry Sternlicht doesn't hold back on his Federal Reserve criticism. On multiple occasions he's told reporters that the central bank's aggressive interest rate hikes could soon spur a deep recession. It's easy to see why Sternlicht is so openly critical of the Fed. Starwood primarily invests in real estate, where the Fed's interest rate hikes have already caused a great deal of economic pain. Last week, Bloomberg reported that Starwood Real Estate Income Trust plans to shop more than 2,000 single-family rentals. Starwood hasn't publicly explained its motive for pulling back from the residential housing market, where its REIT owns over 3,200 single-family homes. That said, it's clear that the decision to shop these 2,000 homes comes as Starwood faces an uptick in redemption requests and endures pain in the commercial real estate sector. At first glance, one might assume Wall Street types would pull back from the commercial real estate space, where office values are sinking fast, and instead pile into the residential housing market, where national home values are rising again after passing through a mild home price correction last fall. However, institutional firms are also timid on the residential front. According to an analysis conducted by John Burns Research and Consulting, institutional investors, those owning over 1,000 homes, bought 90% fewer homes in January and February than they did in the first 2 months of 2022. Why are institutional investors pulling back so fast from the U.S. housing market? It boils down to the fact that the financial return on each additional home added just isn't that great right now after factoring in interest rates, house prices, and rents. Not to mention, some big investors like Yieldstreet think that national house prices, despite jumping a bit this spring, are poised for another step down. We're pretty much on pause across all home buying strategies, Tejas Joshi, director of single-family residential at Yieldstreet, which owns over 700 single-family homes, recently told reporters. I don't think house prices have bottomed yet. On average, we have another 5% decline nationally, and it'll vary by market. Peak to trough, we're expecting a 12% to 15% national decline. Not only are institutional investors buying fewer homes, some are reducing their overall single-family portfolios. Look no further than Invitation Homes, the largest owner of U.S. single-family rental homes, which recently became a net seller. In the first quarter of 2023, Invitation Homes bought 194 homes while it sold off 297. A year earlier, in the first quarter of 2022, Invitation Homes, which Blackstone helped to grow before divesting in 2019, bought 822 single-family homes and sold off only 147. Invitation Homes isn't alone. American Homes 4 Rent was also a net seller in the first quarter. In the first quarter of 2023, American Homes 4 Rent sold off more single-family homes, 666, than it bought, 312. That net decline saw the Las Vegas-based company's portfolio shrink from 58,993 rental homes across the country to 58,639 homes. A year earlier, in the first quarter of 2022, American Homes 4 Rent bought 1,131 homes and only sold off 171 homes. Fed Chairman Jerome Powell has finally admitted what all of us have known for a long time. Specifically, U.S. commercial real estate prices are in the midst of a major correction or even a collapse. And house prices in the United States are in decline. And macroeconomic factors are weakening overall. So, many investors have current needs for cash and need to liquefy some of their assets. The real estate funds have recently seen a surge in withdrawal requests, amid a broad drop in investor sentiment and potential economic downturn. The real estate market in the United States has reversed course. And investor sentiment is turning bearish, to say the least. But most REITs invest in commercial real estate. And real estate is not a highly liquid investment. So, the fund needs to make some sort of judgment as to how much cash it should make available for redemptions. And, in this case, investors in the fund want to take out more money than Blackstone can make. As you might imagine, in a degrading real estate market, publicly traded REITs have gotten slammed this year. If you follow this channel, you already know that the Federal Reserve is aggressively raising interest rates. And the rising interest rate environment is sending real estate values into decline. The real estate market has been hit hard, especially commercial real estate. Practically everyone is raising questions about the actual values of real estate. If you follow this channel, you already know that real estate prices are falling across the United States. Institutional investors snapped up properties during a stimulus-fueled frenzy. But now, rising interest rates have shifted the sands. And they are now unloading their properties in a hurry. For these investors, profit margins have crashed. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.